Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest is David Beck, and David is a fee-only certified financial planner. He has his own practice, Bay Area Planners, and in that practice he focuses on helping families plan for financing the college education. David came to the United States from England in 1982, worked in product management for electronic component manufacturers before starting a second career in financial planning. He graduated in 2006 from the financial planning program at UC Santa Cruz Extension and chose the college planning specialty after helping his niece with financial issues for her college education. And he says he found helping people in this area to be very rewarding. Today we're going to be talking about how tax savings can help a family pay for a college education. And as a caution, this is just an introduction to this area, and help is available for further guidance. So David, thank you for joining me today.
Thank you, Mike.
So we didn't cover this when you and I got together last fall. Maybe you could talk a little bit about why we didn't back then and what's happened.
Well, back then we didn't know what the outcome of various negotiations were on the tax situation. By the way, I just want to mention that niece you spoke of has now graduated.
Oh.
So time flies.
Yay. Well, good for her.
Yeah, so when we were last together, we didn't know what would happen with the American Opportunity Credit and that kind of thing. But it did get extended. It's got extended now through 2017.
So this is part of the fiscal cliff drama that happened, and Congress finally reached an agreement on January 1st, and this was enacted and passed into law, which included an extension of most of the Bush tax cuts, including these education tax benefits. So now we can tell you that they're still there, and maybe we can enumerate some of them for you.
And of course, the drama still goes on with regard to the student loan interest rate, and perhaps we'll talk about that.
Right. So as we get to closing this program, our biggest concern right now in the college education area has to do with financing and student loans. And so we'll give you a brief update related to that, or David will. So David, what's the principal federal tax credit that helps paying for a college education?
It is that American Opportunity Tax Credit, worth $2,500, up to $2,500. The amount depends on the amount you have to spend on tuition, and also whether or not you're phased out of it. It's one of those tax credits that gets phased out according to income.
Yeah, so if you're in a very high income category, then you'll be knocked out from getting this credit.
And it is an income limit that doesn't seem to change. It's one of those limits that as time marches on, inflation with wages and that, a lot of people gradually move closer and closer to those limits.
Okay.
So it starts at $160,000, and the tax benefit, the tax credit rather, is eliminated by the time you get to $180,000 in income.
Right. And since we live in California, in Silicon Valley, which is one of the more high income areas, we see an awful lot of our clients do get sort of phased out of this particular credit.
Yeah, that's true. And if that's the case, then you have to look and see if the student can take that credit, because $2,500, each year for 4 years. It adds up.
It certainly does. It's a very helpful credit. And it replaces some earlier credits that had much lower income thresholds. So maybe just to emphasize the positive there, that a lot more people are eligible for this benefit than existed before it was enacted.
Yeah, the old Hope credit, which was worth less money, and as you say, was accessible by much fewer families. So the American Opportunity Credit is the only tax credit really to be of great value to middle income families.
Okay.
So even some of the other tax benefits, the student loan interest deduction, etc., get phased out at relatively low levels
Okay.
for us here in the Bay Area.
Okay. So maybe you can highlight some of the other tax credits and so forth that are offered for higher education.
Well, that was the main one.
Okay. So you mentioned the HOPE credit.
Yeah, the HOPE, well, the American Opportunity Credit has replaced essentially.
So
the
that's
HOPE
gone.
credit. Well, it's not gone, but we have to wonder what happens
Or
again.
more or less
after,
superseded, right?
Yes, it's superseded right now after 2017. Maybe we'll be sitting here in what's that? Another 4 years in the same situation that we were in last time we met,
Mhm.
not knowing whether that American Opportunity Credit would be extended again.
Right.
If not, then maybe the HOPE credit comes back.
So no, this isn't one of those provisions that got permanently extended. This one is going to be phasing out again in a few years.
It's only safe to 2017.
Yeah, 2017. So it's good to have it. Take advantage of it while you can. Don't count on
Right,
it for.
If you're going to college here in September 2013, you're okay. Your younger brother or sister, may not be.
What about the lifetime learning credit?
Lifetime learning credit, the big advantage I see to the lifetime learning credit for people is that it's really the only credit that goes beyond 4 years.
Right.
So if the education extends to a 5th or a 6th year even, then you have the opportunity of taking the lifetime learning credit.
Yeah.
And also, it's a credit that can be used. It can be more broadly applied.
Mhm.
So it might be a credit that older people not going for a bachelor's degree would still be able to make use of.
Mhm.
However, it's worth less. Maximum's $2,000, and that's $2,000 for a family. So if you have, let's say, two children, both in their 5th year, it's not $2,000 each. It's $2,000 on the family tax return.
Yeah. But this is per year, and so when you've used your American Opportunities Tax Credit, you still have a possibility of getting this lifetime learning credit. There are still going to be some income thresholds I think you need to meet here, right? So
Yes.
yeah.
And there's one other threshold, and that is a drug conviction.
Oh.
A drug conviction will knock you out of the American Opportunity Tax Credit, but doesn't knock you out of the lifetime learning.
Okay. So keep your nose clean, kids, or you're not going to get your tax credits. Oh my goodness. Okay.
Other than that, there's really not much. Everything else falls a long way behind in terms of value and the ease of qualifying for it. So we mentioned the student loan interest deduction. Well, first, obviously, you have to have a loan and be paying interest on it. But that would be useful for a student once they graduate.
Mhm.
But before then, probably it's not that useful to them,
Uh-huh.
because it really needs you to be taking your own personal exemption in order to claim it.
Mhm.
So that's not too useful. Other than that, penalty-free withdrawals from an IRA. Well, that's a benefit if you really need to take the money out of the IRA. But as a financial planner, that's not something I'd be advising anyway. Hopefully you won't be taking money out of the IRA.
We don't want people taking money out of IRAs.
That's it.
Okay. So, although sometimes if that's the only place that they can get money, but that's why you go to David. He's going to help you in avoiding that. Now, how about tax-free earnings for 529 plans? Maybe you can talk a little bit about that. So, this was the tap dancing kids, and there was some of you people that have a few more gray hairs. You might remember those commercials about the California Scholar Share. So maybe you can tell us a little bit about that.
Scholar Share is still out there. So 529 plans are a savings vehicle for college. And the advantage to them is that any earnings on the money that you put aside, if you use it for a qualified educational expense, won't incur any tax. So but with any savings account that we're talking about earnings, it needs time really for those earnings to generate. So it's if you don't start a 529 plan early, then the savings aren't going to be so much. The best time, obviously, to start it is as soon as the child's born. If the world isn't going to change, that child's going to need probably more education, not less, in the future in order to get a good job. So we really should hope that almost every child goes to college in order to maximize their human potential. And if they're going to go to college, we probably shouldn't expect it to be any less expensive relatively than it is now. So by all means, open the 529 plan as early as possible. Get the full 18 years of horizon, 18-year time horizon on any gains, so that you're not paying any taxes on them.
So maybe there's a few things we should talk about related to 529 plans. So one is there's a special election that's available as far as when you're trying to put a big chunk into one of these things, and maybe you can talk about that for a minute or two.
Yeah, there is this special election that allows you to put up to 5 years of a gift. So the gift this year is $14,000. I think it went up from 13 to 14,000.
Right.
So a parent can gift $14,000 and put it into a 529 plan in the child's name. 2 parents, that would be 28,000. 5 years times 28,000 is what?
140,000.
Yeah. So so if you want to kickstart, if a family wants to kickstart a 529 plan for a child, 140,000. However, after doing that, you can't put any more money in for the following 4 years. Mm-hmm. The interesting thing about 529 plans, though, is that they're not actually a completed gift. The money comes out of your estate by going into the 529 plan. And normally, for it to come out of your estate, it has to be a completed gift, an irrevocable gift.
Right.
And there are not supposed to be any strings on that gift that you can pull it back. The 529 plan is the exception, because you do have the opportunity to change the beneficiary of the account.
Right. So if Sally has one of these accounts that you've set up for her, and she says, Mom and Dad, I guess I'm not going to college after all. Oh, well, what a shame. I guess we'll just have to give it to your brother or your other sister, and then they can use this 529 plan. So anyway, that is a dramatic difference from any other gift that you can make.
Right.
The other thing
in families with multiple children, though, it usually doesn't work that it's a sequential thing. Unfortunately, mm-hmm. for the family, they set up one account and put Johnny through, and then still money left in the account. Then they put Sally through. Typically, children overlap, so
yeah.
you probably do have to set up multiple.
Oh yeah,
multiple
no,
accounts.
you will. Now, there's a couple things related to this, folks, and that is, in order to get that spread that we were talking about, in other words, in order to front load it and treat and use the exemption that you would otherwise use for the subsequent years, you have to make an election on a gift tax return. So a gift tax return has to be filed in order to get that benefit. And I've had some clients that didn't tell me about it because they thought that it was covered, and created sort of a tough situation. So anyway, so just be aware of that. Gift tax return, when you're doing this, is pretty simple. It won't be very expensive, and it's a nice piece of insurance to avoid what would otherwise be a gift taxable event. Now, the other thing, though, don't panic, because now we have a $5,250,000 lifetime exemption that applies for estate and gift tax. So for most of us, it may be sort of a so what.
Absolutely, and we should make that clear. People get frightened that if they file this form that says gift tax, then that means they have to pay some tax.
Yeah.
It's going to increase their taxes. And as you rightly point out, well, it won't.
Yes. Okay. Well, we talked about some of the difficulties that higher income people have related to phase outs for some of these tax benefits. So what else should they be thinking about in order to help out in this process?
Well, when we're thinking of taxes, what we should be thinking of is the family as a whole paying the lowest amount. So are we filing just one tax return, the parents filing one tax return and the students not filing a return? Or are the students filing their own return? And if the income to the family is split between these different tax returns, which way of doing it produces the lower tax bill?
Mm-hmm.
Filing everybody on the parents' tax return, or students filing separately.
Mm-hmm.
The idea being that there might be some opportunities to transfer either assets or income to the student so that they benefit by having a lower tax rate.
Mm-hmm.
This is kind of complicated stuff. Luckily, I think with tax software these days, it's possible to go in and talk to your tax preparer, and they can set up a separate tax return for the student and deal with kiddie tax, that kind of issue within the software.
Okay, so what is this kiddie tax stuff and how does it play into all of this?
Well, the kiddie tax was set up really to stop people doing this, to stop people transferring assets easily to the children. And it basically says that beyond a certain point, a fairly low point, any unearned income that the child has will be taxed at the parent's rate as opposed to the child's rate.
Mm-hmm.
So potentially, that means you're not really benefiting by transferring the asset. But that's that may not it may still be a benefit to do that. First of all, you've got the original amount. Is it still $1,900?
I can't. Are you talking about their personal?
Yeah, the unearned income. On the first $1,900, if it is still $1,900.
I'm not quite sure where it is right now, but it's not a real high amount. But what happens, is that they give you a certain exemption amount. It's like a standard deduction that applies, and then there's also a fairly small amount, like $500 or $600, that's still subject to tax at a low tax rate.
Right. There's the first 950 is exempt. The following 950 is taxed at 10%. So that would be on the first $1,900 of unearned income, like investment income, capital gains. You'd only pay $95. But after that, it would go to the parent's tax rate. So they actually look at the parent's tax return, grab that tax rate, bring it over to the child's tax return.
And maybe we should say the family's tax rate, because you have to pull in for all the kids. The other thing is this used to cut off at a fairly young age 14. So where does it cut off now? 19,
unless you're at college, in which case it will go up to, I think it's 23 or 24.
24.
24, yeah.
So it's really kind of wild how far, because these are legal adults, and yet they're subject to this kiddie tax.
Right. However, the student still has a standard deduction and possibly the personal exemption. So in addition to transferring assets and transferring that unearned income, you might see if you can transfer earned income.
Mm-hmm.
And that would be for a business owner family being able to employ their child.
Mm-hmm.
And the more income, the better. So if we go back to the American Opportunity Tax Credit, if the family doesn't qualify because they're making too much income,
right.
Is there a way to have the student file their own tax return and to have sufficient income to pay taxes? And if they're paying taxes, can then those taxes be wiped out by them taking the American Opportunity Credit themselves?
Mm-hmm.
Not easy to do. One of the most difficult things is just to get the child to be able to earn sufficiently to owe taxes and owe sufficient taxes to make it worthwhile trying to go for the credit.
Mhm.
Remember, these are students. They're not
Right.
supposed to be earning, spending long hours in a job earning money.
Well, some of them do so well that they forget about this education stuff. I heard about this guy named Bill Gates. He dropped out of Harvard University. The guy's never going to add up to anything.
Well, that's all. Michael Dell starting a company in his
same
dorm room.
thing. Yeah, you know.
Now the idea is to write an app.
I guess so.
Yeah.
Um,
But what else can you do in your dorm room? I know whether Avon is still popular, would be popular among students, but there can be other little dorm-based businesses.
oh, sure.
For sure.
Oh, yeah. How does all this stuff interrelate with financial aid? So if you have a child that's earning, all this money, or, the family situation, and we have these different things that we're looking at. What's the interrelationship? Because a lot of times saying, can my child be independent? Is that going to get them in a position where they're going to be qualifying for financial aid? I hear that they should just claim their own exemption. I don't claim them as an exemption on my tax return, even though I support them, which I always have a difficulty with, because they have to provide more than half of their support in order to claim their own exemption.
That's
maybe,
it.
Maybe
yes.
you can talk about it a little bit.
Well, yes. So the first thing is this concept of the child is independent. The child is independent. It comes home after midnight. He has maybe his own source of income and spends it how he likes. However, that doesn't meet the definition of independent with regard to financial aid or with regard to the parent having to stand behind the child. The only way for the child to be considered independent and get financial aid without the parents being involved is if the child is over age 24, married, has a child, a few other things that you really don't want within the family. So for the most part, the families, in a family, the parents have to stand behind the child, and in other words, their income and assets will be taken into account in the financial aid calculation. So to answer your question, how does these kind of tax strategies and financial aid mix? They don't. You go one route or the other. If you can get financial aid, you don't want to be messing around with trying to transfer income and assets to the student. That would counter your goal of getting financial aid. On the other hand, if you're not going to get financial aid, then these are strategies you should at least look at in order to reduce your overall tax bill. And if you're reducing your overall tax bill, you treat that as saving money, as a tax scholarship from the government that you can put towards college.
Okay. So you could look at it as a little contribution from Uncle Sam.
That's it.
That can help out.
That's it.
Okay. Well, we have about 5 minutes left. Maybe we should talk a little bit about some of these other new developments that aren't necessarily so tax related.
Mm-hmm.
But maybe you'd like to talk for a few minutes about the California Middle Class Scholarship.
Yeah, so this is a new initiative. It came out of Proposition 39, which I remember voting for. I didn't know it was going to come out in this particular form. The idea is that the limits for Cal grants are at about $80,000 to $90,000 in assets, somewhat less in income. So a lot of people don't qualify for a Cal grant. The idea, it is called a middle class scholarship, is that it will cover people with earnings from $100,000 up to $150,000. And what it will do is it will reduce the tuition fees at California state universities and in the UC system. And the amount that it will be reduced depends on the income. So the higher income, it's a bit like being phased out. But also the program is being introduced gradually. It's been introduced over the next 4 years. So the numbers that you sometimes read about in the paper, that it will reduce the tuition cost by 40%, that is only at the $100,000 end of the scale, and it's only in 4 years. And when we think about that, in 4 years, there will have been price increases throughout the system. So they will have negated in current dollar terms some of the effects.
Okay. Just have a couple minutes left. Why don't you talk a little bit about what's going on with student loan interest at the federal level?
So the discussion was whether or not to extend the subsidized Stafford loan interest rate of 3.4%, but what's come out of it is it's gone to a variable interest rate, which starts at a good level. So a lot of students and families will actually, for any loans taken out in 2013 to 14, will actually see a lower interest rate than they were seeing. But interest rates is based on the 10-year T-bill, which is at a very low level historically now. So they're only going to go up.
Okay.
There are caps, but those caps are higher than what people would be paying now under the fixed
Now,
rates.
is this adopted legislation, or is this like a proposal, or where do we stand related to this? Because I understood it was the previous limit had sort of expired.
Yes, so it expired on July the 1st.
Yes.
What they want is something in place for the beginning of the school term in September. So the two sides are moving really close together now. They've seemed to have reached a compromise. It's not a done deal yet, but it seems to be
This
where
seems
we're
to be the
headed.
direction. Okay.
Yeah.
David, I want to thank you so much for coming today and sharing this important information. Folks, financing a college education is tough. It's expensive, and so it's quite a process in figuring the direction that you're going to go. But there are people like David who can help you through this process, and just be aware of that help is available. So anyway, with that, I think we'll just see you next time on Financial Insider Weekly.